Hey, what's up? Welcome to day 21. What am I saying? Hey, Spotify. Welcome to day 2021, third week, that's what it is. The third week of the Zang Fund. So, very glad I've been able to kind of keep this up for 3 weeks so far. Hopefully, when school starts, I'll be able to keep going. But I think what I'm going to do today, I don't have much time. It's already 3:20, and I'm gonna go help Allison move out later. So the time that I do have, let's take a look at what I wanted to do today. So read the news. I was reading the news earlier a bit, some of the blog posts that other people had. Don't know if I'll start the peer evaluation. I really hope I can do this one, and weekly report number 2. So let's do this, because I want to try to finish the DCF. I don't think I'll be able to do it today, because there's still a lot I kind of have to learn. But I think I can get pretty close. So, VFC, DCF. Is this the right one? No, this is not the right one. There we go. So we have our debts, and then we also have, so we have our weighted average cost capital. We have all of the information from the balance sheets, the cash flow statement, and also the income statement. So I think today I kind of want to go about how to forecast the cash flows for the business itself. So there's 2 cash flows I want to forecast, both free cash flow and free cash flow to equity. So I think I'm gonna start reading the chapter on measuring cash flows right now, forecasting cash flows. So reading chapter on forecasting cash flows. Okay. So it's there right now. Ooh, before I start, I'm gonna grab a pencil real quick so I can take some notes. Buggy, come here. Buggy, come here. Buggy, come here. Come sit. Buggy, come here. My dog is here. Okay, got my pencil. Oh, you don't want to go? You want to leave or not? Using historical growth rates to forecast future cash flows, and then look at the equally estimates of growth. Company. It's a fun variation. Estimating the terminal value and how to keep this number from becoming unbounded. In particular, we look at the connection between terminal value and reinvestment assumptions. The final section of this chapter, we consider three variations on cash flow forecasting: expected value estimates, scenario analysis, and simulations. To value an asset, we have to forecast expected cash flows over its life. So that's what value is. What's the value from expected cash flow 1 over t plus terminal value. Oh my. Basic idea of DCF / In keeping with the distinction between valuing equity and valuing the business that we made in previous chapters, we can value equity in a firm by discounting expected cash flow to equity, terminal value of equity, the cost of equity. Or we can value the entire firm by discounting expected cash flows to the firm and the terminal value of the firm at the cost of capital. Value equity in a firm by discounting expected cash flows to equity and the terminal value, the cost of equity. Or we can value the entire firm by discounting There are three components to forecasting cash flow. First, determine the length of the extraordinary growth period. Extraordinary growth period, different firms spreading out life cycles. How long a firm will be able to sustain high growth is perhaps one of the more difficult questions to answer in evaluation. 2 points are worth making. One is that it is not a question of whether, but when firms hit the stable growth wall. high growth and valuation, or at least high growth that creates value, comes from firm earning excess return on their marginal investments. So I guess that's the idea of weighted average cost of capital and return on invested capital. So this growth without excess return will make a firm larger, but no. In a competitive market, these eventually draw on new competitors. Returns with speed. You should look at 3 factors considering how long a firm will be able to maintain high growth. Smaller firms are much more likely to earn excess returns, and otherwise similar larger firms. More to grow. Large potential. When looking at the size of the firm, you should look not only at its current market share, but also at the potential growth in the total market for its products and services. Okay, that's pretty good intuition. You should not look only at its current market share, but also at the potential growth in the total market for its products and services. A firm may have a large market share of its current market, but it may be able to grow in spite of this because the entire market is growing rapidly. So I call this market share versus market's growth. Existing growth rates and excess returns. Momentum does matter when it comes to projecting growth. Firms that have been reporting rapidly growing revenues are more likely to see revenues grow rapid, at least in the near future. Firms that are earning high returns on capital and high excess returns in the current period are more likely to sustain these excess returns for the next few years. Magnitude and sustainability of competitive advantages. This is perhaps the most critical determinants of the length of the high growth periods. There are significant barriers to entry and sustainable competitive advantages. Firms can maintain high growth for long periods. If though there are no minor barriers to entry, or if the firm's existing competitive advantages are fading, we should be more conservative about allowing for long growth periods. The quality of existing management also influences growth. So momentum does matter. Comes to projecting. Try to. In the United States near So it seems like Damodaran is Chip Bentley. Damodaran is making claims about some of these companies here being in periods of high growth. 2000. Seems like he was right. When was this book written? 2004, 2005? 2006. Okay. Okay, yeah, I could see for the next 10 years, 2016, it declined back to 20. Interesting. So that was, that IPO'd about 7 years before. So 7 years before the book got published. What about Toyota Motor Corp stock? He thinks this periods of high growth. Avian Corp stock. So this, I think, was the broad sell-off in stocks. All-time high of 30. Oh wow, so you could get it at pretty cheap compared to the IPO. I wonder if that means something with So its operating expenses have increased somehow. All right, it's okay. So its operating income has declined a lot, most likely due to the increase in okay, so there's been a large increase in marketing expenses. I'm assuming this is probably wages, research and development. So yeah, if we remove this and we capitalize the research and development expense, then maybe the company is earning a profit, but then we would depreciate or amortize the expense itself. I see. Okay. Balance sheet. How much cash does this company have? Total assets, current assets, has a decent amount of cash. Where is it getting this extra 50? Okay, so cash flow from, I see, so it took on some debt last year, so that's why I was able to increase its cash. I wonder if that is worrying for a company that isn't making any money to then take out a $120 million loan. Yeah, I wonder if that's something that is alarming or not. I don't know. Maybe that's... Okay, that was getting sidetracked a little bit. Now I gotta go back to this. Nintendo. Turn on the capital. Okay, so there's Nintendo stock. It's not super low. It's not super high. Target, so okay, because it already has a pretty high valuation. Hello, no PE. So target stock back in 2006. Yeah, okay, there's a period of large growth. $3. Well, $2. Okay. It's back in 1984. So, holding something like this for 3 years, for 30 years, that would be 40 years now. So I'm 20. By the time I turn, that'll be when I turn 60. But 50 times. Yeah, man, I need to invest early, start when I'm young, and then buy and hold a company that is going to grow 50 times. Jeez. Okay. There's also rare. Stock. So 2000. So it seems like seems like there hasn't been much growth overall. There's also Sirius satellite radio. So Sirius XM. Okay, so yeah, I guess Dumbledore didn't predict that streaming would become really popular, and so the satellite radio business probably isn't as great as he predicted it to be. Once the length of the extraordinary growth period has been established, we have to forecast cash flows over that period. So in each stage of the process, that we will be called upon to make our best judgments on how the company being valued will evolve over the coming years. Once the length of It is in this stage of the process that we will be called upon to make our best judgments on how the company being valued will evolve over the coming years. Valuation is an art. So when estimating the expected growth of the firm, generally begin by looking at the firm's history. How rapidly have the firm's operations as measured by revenues or earnings grown in the past? While past growth is not always a good indicator of future growth, it does convey information that can be valuable in making estimates for the future. Now looking at measurement issues that arise when estimating past growth, and then consider how past growth can be used in projections. The average growth rate can be varied depending on whether it is an arithmetic average or geometric average, right? Compounding that occurs from period to period. So, the geometric average is a much more accurate of true growth in past earnings, especially when year-to-year growth has been erratic. So why is that? Earnings 0. So he's saying that we keep one of the earnings constant. Oh, I see. So we have to keep earnings constant. So why is geometric growth better? Okay, so I guess with positive growth, your geometric average is always going to be less than your arithmetic average because of the compounding effects. Higgledy piggledy piggledy. LOL. All too often, management's forecasts represent wish lists rather than realistic expectations for the future. Finally, management forecasts can represent assumptions, combinations of assumptions. By utilizing existing assets more efficiently may generate some long-term growth. It is difficult to see how it can be the basis for long-term growth. Oh, my family's back, so I might end the stream here and move back up to my room. Yeah, bye.